We'd like to thank you for joining us today for this webinar. The subject of today's discussion is supply chain risk, how to alleviate that. Our speaker is Wally Baran, and he will be with us in just a moment. Once again, keep in mind that all participants will be on mute during this broadcast. If you have questions, please use the built-in question facility of GoToWebinar so that you can post your questions. We'll either get to them today or during the broadcast, or we will get them to you individually after the broadcast. I'd like to now turn this over to Jim Satterfield, President of Firestorm, and he will introduce Wally Baran. By the way, our Twitter, if you wish to follow on Twitter, hashtag is #FS Supply Chain Risks. Or you can also follow on Facebook, facebook.com, Firestorm Solutions. Thank you. Over to you, Jim Satterfield.
Thanks, Bill. We appreciate it, and thank you all for attending today. This is the inaugural of a series of webinars that will be done in conjunction with the University of Alabama Continuing Studies program. University of Alabama has obviously a great deal of expertise in a variety of areas, and supply chain is specifically one of those. And so each month you're going to find, as part of this series, underwritten by the University of Alabama's Continuing Studies Department, a series of educational webinars on these topics, giving you some unique insights into those areas. We also are planning some other activities together, and I would encourage you to look for those series as they're coming out. I believe the University of Alabama is going to be in Mobile on Thursday of this week at a conference hosted by the Mobile Chamber of Commerce. And if you've got specific questions, that'll be an opportunity. We'll also have a representative there to deal with those topics. So as we talk today, we wanted you to know that this presentation, you need to be able to hear what's being said as seeing just the slide deck, and so it's not complete without that. And then, as we have on all of our webinars, we refer to the fact that any work product provided must be read in conjunction with the guidance given by national, regional, and local authorities. So this isn't a plan, and it's not legal advice, but it is a good opportunity for you clearly to understand more about supply chain risk and opportunities in being able to address the issues that you're there facing each day. I'm Jim Satterfield, President of Firestorm, and I'm so glad that you are joining us today and have a chance to meet with Wally. We've done some presentations together in the past, and Wally is a nationally recognized expert in the supply chain area. He's a graduate of Georgia Tech. By the way, I am too, and that's maybe one of the reasons why I think Wally certainly can walk on water in a variety of different areas. He's been a senior partner with national accounting firms, a great deal of practice in this area. And with Wally, you get an interesting blend, not only of the academic approach, but that of the practitioner, the person that's been involved in seeing the impacts within a business and how these elements come together. So we're into receiving a lot of information today, and I think you'll have some good insights, and hopefully we'll have some time left over for some questions as we move forward. Wally, tell me a little bit about the agenda today.
Thanks, Jim. It's a pleasure to be with you. I thought we'd talk about 4 major topic areas today, and then obviously we want to answer whatever questions that we can. If there's a need to follow up on those, we'll be glad to do that. We want to talk about the new supply chain world. It's a very different place than it was just 15 years ago, certainly than it was 25 years ago when I first was doing, trying to lead parts of supply chains. And I want to talk about why that's different and what drove that differences. We want to talk about the way it's created and driven risk, and what we refer to in the supply chain as risk as inevitable surprises. Because it's not a question of when the risk will occur, or if they will occur, it's when and how you'll be impacted by them. Today's supply chain, as you'll see, is much more risky than past supply chains, and it's something that managers need to think very carefully about and even take different approaches and different frameworks to think about risk in their supply chain and how to achieve performance. I'm going to talk about a few key issues for suppliers and customers. We picked out the top 4. There's 8 or 10 more, but we picked the top 4 to talk to you about today in terms of things that are most important and things that people are struggling the most with. And finally, we want to talk about implications for managers, particularly for those people who may own a supply chain and be supplying it in customers, people who may own a major piece of a supply chain, or people who are suppliers within that supply chain. And there's opportunities and as well as the risk associated with that. So we're going to talk a bit about that. So that's our agenda for today. And again, we appreciate you joining us. Let's talk a little bit about kind of a historical walk. I want to spend not a lot of time with this, but enough time to really give a perspective on kind of how and why things have changed. In the past, when I first started working in supply chain 35 years ago, you know, supply chain was,
that old?
Yes, indeed, and it shows many days. But if you look at the old supply chains, it was really an optimization of labor cost, equipment cost, capital cost, and transportation costs. So where do I put my factories, and how do I then get my product out to my customers? That was the classic supply chain. So many of you may have seen you know, various different even modeling tools, from CAPS logistics to Inside Inspect, et cetera, that all were, you know, really trying to understand and simulate the design of what supply chains would look like to optimize total delivered cost and delivery performance. It was all based upon a labor cost, transportation cost trade-off. The risks were known and familiar. The trade-offs were clear. It was mainly a regional supplier game. There were a few, global suppliers, but frankly not a lot. There were clear choices and design options, and it was a very stable environment. And in fact, one of the things that we'll talk about a little bit later, it was also a declining cost of capital environment, which has made everybody look good in this space for quite some time. But things have changed a lot. So if we look at supply chains and the way they've changed very significantly in the last 25 years. The scope has gone from regional to global, and vertical integration is probably the most interesting part of this. If we look 25 years ago, the average company made over 50%, most as much as high as 70% of what they actually sold. Today, that number is under 15%, which means then that the majority of the supply chain of most companies is in fact owned by others. The majority of the capabilities in your supply chain is owned by others, and yet we're treating them as a supplier, not as a partner, in the way we think about how we're going to run our supply chain. We plan about our supply chain, the stuff that we own, not about how we manage an overarching network. The network is thought of as a tactical place in which we interact with suppliers, not as the core capabilities of our company. That's a big deal. The other thing that's changed in terms of is cycle time and inventory days. You had about 0.8 to 0.5 inventory days coverage per cycle time day in the past. Today that number is below 25%. We have 1/4 day of inventory for every cycle time day in the supply chain. What that means is that any disruption, any event that creates a ripple in the supply chain or a disruption is going to affect you far more and far more quickly than we've done in the past. I often refer to this as the dark side of lean. Lean is an interesting JIT, quality. All those programs have been wonderful things and have done things for companies, but they've applied them within their operation, and they've leaned out their supply chains without understanding the risk associated with it. And ask companies like Toyota the impact of losing 7% market share associated with an earthquake or a tsunami, and you understand the impact of the dark side of lean.
So there's no buffer, is what you're saying.
The buffers have been dramatically reduced, and inventory is something that the financial community has pushed very hard on, in spite of the fact that inventory is the smallest part of your cost structure. So if we look at it, there's a customer competitive environment has changed as well. Again, we're now working in global markets with diverse and conflicting channels that the supply chain is expected to be able to perform across. It's complex, challenging environment, very unforgiving. We get buying criteria of customers buying for a variety of different reasons, and demand going up and down, highly variable. Response time is supposed to be next day to a week versus it used to be 2 to 4 weeks. Again, lean, high outages, the whole visibility has been lost across the supply chain as we've gone from making 50 to 70% of what we actually sold to now making less than 15%. In that process, we've lost complete visibility of the other 85%. Yes, I can pick up the phone and call someone, and they could tell me the status of my order or the status of the products that I'm buying from them. But I got to call a couple of thousand in order to understand it. I don't have the systems to be able to do that. And as you'll see later, the systems we have invested a huge amount of money in is within the four walls of the factory, not where the action is, which is outside of the factory and outside of our distribution system. It's a whole nother world with highly tailored logistic streams, flipping and diverse channels, and the supply chain is supposed to do it with the assets and capabilities largely that have been put in place in the past with a whole different strategy. It's creating an interesting problem for people, and one that we have to begin to address differently. So we look at kind of what's driven all those changes. This is an interesting chart to me that begins to talk about the pressures on the supply chain. And the result of that pressure on the supply chain is increasing risk, whether it's demand variation, product complexity. One of my clients has gone from, in the last 15 years ago, they had 46 brand package configurations being sold through 7 channels. Today they're in 40 channels selling over 1,600 different variations, and they haven't appreciably changed the assets, but the supply chain is put in a position to try to use the old assets and the old capability, the old thinking, in trying to deliver a much more complex, much more varied, into a much more demanding customer, and we wonder why the supply chains are having problems. They simply weren't designed in most cases to do the things we're asking them to do today. And behind that, we haven't thought about the supply-based structure. That is a tactical issue people are thinking about. The number of suppliers has increased dramatically. The average company today has between 3,000 and 7,000 suppliers. Some, like a Walmart, has 60,000 suppliers. And when you look across that world, in Walmart's case, each of those, when a supplier is out, you're out of that particular product. For a number of people, if one supplier or 2 or 3 suppliers fail, they can't build the end product, even though they may have 97% or 99% of the products they need from other suppliers. The risk associated with it, the information, the visibility to know when it's happening and why, then we're in a position that we don't know how to move forward. So this is a very complex risk area, one that has lots of demands on people, and one that people aren't focusing enough attention on.
By the way, that looks like a Jaws picture you got there, Wally. You're just getting crushed by the big jaws coming down together?
A lot of companies are, and we'll talk about why. But at the end of the day, it's a very different environment. And that's why you saw at the front end our challenge. Are you fighting today's battles with yesterday's thinking? Most people are, and we've had people trained in supply chain management. They've been trained in the historical view of supply chain management. We've had people grow up and focus on their operations. We haven't had people do is focus on total supply chain and the risk associated with it. So let's talk a little bit about that. So today's supply chain is much more complex and much more challenging, and as you see, risk is at the center of it. Whether it's supply-based, the service offerings, the complexity, the variability, all those things have dramatically changed the supply chain challenges that executives face. Yet we haven't changed the planning tools, we haven't changed the understandings, we haven't done the analysis, and we've really focused on how to optimize our own structure, even at the expense of the total supply chain. And that's what we're going to spend time talking about today. So as we look at it, this is a source of inevitable surprises. Here's another picture of the supply chain. We talk about the risk areas here, from supplier failures, financially, capacity constraints, natural disasters, delivery errors, go down the list. There's a broad range of potential risk areas in the supply chain, most of which are not well understood, many of which are not particularly well managed. And if we look at it, it can cause some interesting problems. BP is probably the most obvious one. BP I find fascinating. BP has lost over $50 billion in wealth. Now, part of that is in the cost of in the value of their stock, but over $25 million in fines and in cleanup costs, and the clock continues to tick. The fascinating thing about BP's failure is, yes, BP made a bunch of mistakes, but the failure came from a supplier's supplier. It was not a decision made by BP as to who that supplier was with a blowout preventer. That was made by Deepwater Horizon, the drilling company, and they bought it from a company called Cameron Iron Works. Cameron Iron Works has lost millions, but they haven't lost billions. Deepwater Horizon has lost millions, but they haven't lost billions. The BP is an interesting case where the company has inherited the risk of all their suppliers. That's a very obvious case, but it's happening now increasingly frequently. One of the things we'll talk about is you will inherit the risk associated with your suppliers if you don't manage it. You'll inherit it if you do manage it. but what you don't know can in fact hurt you. And you can't outsource risk. You can't outsource the accountability for those risks. You retain, if you will, the authority, and you therefore retain the liability associated with it, whether that's in a legal case or whether that's in the court of public opinion. Big deals. I also find the whole Ericsson and Nokia an interesting case. So you may remember back to the Kobe earthquake, which was before the tsunami of a couple of years ago. The Kobe earthquake, Nokia and Ericsson were neck and neck. This was pre-iPhone. But what was fascinating coming out of that particular battle is Ericsson was about to come out with a brand new product, as was Nokia. And if you remember, Nokia had a real dominance in the cell phone marketplace until along came the iPhone. But if you look at it, what happened there was about 2 months before the introduction of the new products, as they were beginning to ramp up production, the earthquake hit. There was a single supplier of chips associated with both of those phones. Now, by the way, it came from another supplier. Each one of them had a different supplier, but they all bought chips from the same company. That company was affected dramatically by the Kobe earthquake. Nokia recognized within hours that, in fact, they had a problem with the major supplier of their brand new chips and moved to lock up capacity from anybody else that could make those same sets of chips, and they had the designs that they retained and could move the production capacity elsewhere. They had planned for growth. In this case, they used that to respond to the earthquake. Ericsson figured out more than a week later they had a problem, went looking for capacity, and it had all been acquired by Nokia. Nokia gained almost 50% in market share, and Ericsson virtually exited the cell phone marketplace. It was caused by a supplier problem. We can argue who had the best design, but the only design that made it to the marketplace was Nokia. And that's an example of supply chain failures that are driving business failures and driving new product launch failures. The supply chain failures have a massive impact, not just on the production environment, not just on individual customers, but on fundamental company performance and the ability to stay in the world, in business.
So when the supplier fails, that company's customer views the company failing, not their supplier.
Correct. And you can look at that in terms of, you remember the recent problem with peanuts. And all of a sudden there were peanut products that were being sold that were then being used in end products. And two of the people who bought those products are no longer in business today, not because they failed, but because the supplier failed. The good news for a number of those companies is back in those days, which has been now 5 or 6 years ago, the liability wasn't taken legally out to the customer. Today's world, it is not clear, but certainly it's increasingly going down the direction of a company owns the failure of its suppliers, and particularly it owns it in the mind of public trust, but it's also beginning to own it in the legal responsibility in terms of impact and damage.
So what you said about inherited risk here, which is an interesting thing, like you can pick your friends but not your enemies and your relatives at this point. It's your supply chain then could well have been a bad selection choice that you don't know until it's too late.
Right. And one of the things we'll talk about a bit later is how many companies would think of running their business without an information technology strategy, without an architecture of how they're going to manage information technology. Yet with 85% of the capability and assets in other people, how many have a supplier network architecture? How many of them think through strategically which suppliers to be in business with and why? And which ones are not only going to help me with today's business, but tomorrow's? We'll talk about that. That's an emerging issue that's coming out. This is no longer a tactical procurement decision. It's a strategic decision of who you want to be in business with, because you're inheriting their risk, you're inheriting their capabilities, and again, you can outsource the activity, but you can't outsource the responsibility. So let's talk about the 4 key priorities. One we'll talk about is information visibility. We've lost visibility on 85% plus of the supply chain. When we have problems, we're dependent upon suppliers calling us and telling us they have problems. We don't have the information in any kind of analytical formats that allow us to identify where and how problems are occurring across the supply chain with our suppliers, suppliers, or with the suppliers to those suppliers. And yet that is going to affect our ability to perform and serve our customers. Complexity growth, dramatic change in the product complexity, in the service level complexity, in the packaging, and that complexity is rippling back across the supply chain in terms of its impact on production facilities, distribution, in some cases the delivery of product to customers, but all the way back to suppliers, smaller orders, more responsive, I should say more demanding schedules, and faster response and change across the supply chain, for which the supply base is often not prepared and the failure occurs. Identifying the risk and the risk sources, most companies don't have a clear view of that. They don't know their own risk in some cases, but they certainly don't know the risk of their suppliers. This is becoming a very hot area and very important. And then finally, we've talked a bit about the inheritance of risk. That's going to become an increasingly difficult and challenging issue. So let's talk about each of those. This was fascinating to me when we put the information together. Over the last 25 years, U.S. companies have spent $1 trillion on new information technology around internal planning and control systems within their supply chain networks. But they've spent virtually no money on the systems that would support the understanding and management of their supply chain outside the four walls of their company. So massive investment, lots of capability, lots of challenges and risk associated with putting in that capability, as many of you may well have experienced. But in fact, the investment was on the increasingly shrinking part of the supply chain. And we haven't addressed the information needs and demands across the supply network. In some cases, there are legal barriers. If I'm a supplier to two companies that are in competition with each other, there are legal barriers of what I can in fact share with them about how much I'm producing for someone else, or how much of my capacity is available or not available. So there are interesting legal issues and interesting business issues that are arising as people are increasingly relying on their supply chain, and their competitors are relying on some of the same suppliers. And in some cases, they're relying on the same suppliers and don't even know it. I've got two different direct suppliers, but the supplier is in fact the same company. Lots of interest. And so if you look at it,
More than mine.
apparently I'm not speaking loud enough. I will certainly try to speak louder. But when you look at it across how the product complexity changed, what you found was a tremendous growth in manufacturing, distribution, inventory costs, and manufacturing costs as the number of products flowing through their network changed rather dramatically. It's interesting when you look at, well, where profitability peaked. I should back up. If you look at the next chart, you begin to see why all this complexity flows through. This is simply it's an eye chart, so I don't expect you to read it. But the bottom line is complexity drives cost and drives issues in every part of the supply chain, both within the company and outside the company. If you look back to the chart of my beverage client here, what you find is their profitability peaked long before the number of SKUs hit their limit. And in fact, what you find is as people are introducing more and more new products, and by the way, they may have no choices associated with that, but as you look at introducing more and more new products without changing the design of the supply chain to support it, you're getting reduced profitability, and this is one of the reasons companies continue to struggle with the profitability levels that they want to meet, and the supply chain is getting beat up associated with it. But in many cases, it's simply because they've exceeded the design limits of their supply chain. So let's look at a framework some people are able to use in assessing risk. So if you look at it, we use the STEEP analysis that starts with societal, technological, economic, environmental, and political risks. We add to that the specific risk associated with the supply chain, from suppliers to the infrastructure providers like ports or transportation companies, etc. Customer requirements, you can read the list. And then look at that across their impact across each area of the existing supply chain, from suppliers all the way through to our operations. And what you find here is you can find risk in a number of places. We first used this with an electronics manufacturer on the West Coast. The result of this analysis, they had over 200 risks they didn't know they had built into the supply chain. What we found was interesting about that is by changing the structure of the supply chain, we were able to eliminate about 80% of those risks and put ourselves in a position to manage the ones that we couldn't eliminate associated with design. So very importantly, companies are now beginning to say, I've got to take a new look at my supply chain, and this is how they're beginning to say, where are my risks? What do I do about them? Which ones can I manage? Can I design out those that I can't manage? And for those that I can't design out, how do I react and respond? How do I identify where and how they're likely to happen, when it's occurring, and contingency plans on what I do about it? So the last point we've talked about is supply chain owners inherit the risk created by their suppliers. You could look at this. It initially came out of kind of the financial world of the FFEIC and the Consumer Financial Protection Board. But if you,
Wally, I think we have a sound.
I don't think the screen's moving.
okay.
Would you back it up once or twice and see if we can get it to respond?
You can tell this is a live presentation because we're having the joy of exciting playing back and forth. We're going to check on that process now. So while we check on the screens, why don't you pick back up? I think we're on schedule or even ahead of schedule, so we have some flexibility in here. So
Got it.
I'll turn back to you.
Got it. So if we look at it from a standpoint of where does this inherited risk kind of concept come from? Initially it came out of the financial community, which said if you're buying loans from someone who's originating these loans, then in fact you're going to own any risk that's embedded in there for the fact that they've had inappropriate practices, they haven't addressed the appropriate questions and the appropriate information to borrowers. It came out of some of the financial meltdown that we had associated with mortgage lending. But even before that, in the aerospace and defense world, if you look at the track back that they require in terms of components and materials, the aerospace and defense world has very much long been down the path of you need to be able to manage the risk associated with your suppliers. And if you look at it in terms of where airlines and aircraft companies have had to have some legal risk exposure associated with crashes, it's been in fact because in some cases they weren't providing proper maintenance practices because they didn't understand all the requirements associated with the product as designed by suppliers. And look at what happened to Ford with the Explorer. The problem with the Ford Explorer came from the gas tank being located over a particular area of the vehicle. The suspension was not beefed up in that area, and the tires weren't adjusted associated with that as well. And so you had the suspension maker combined with the axle maker combined with the tire manufacturer created the Ford Explorer rollover problems. But it was Ford that lost market share. It was Ford that lost in terms of suit settlements. So again, they inherited the risk associated with their suppliers. How are we doing on the slide visibility?
Bill's going to move it forward in your own information visibility with the supply chain risk priorities at this point.
Got it. For the technical problems, my humble apologies. So if we come back to the risk priorities, information visibility, complexity growth, are finding an extended information visibility to be a critical priority for the future. Companies are starting to really look at this problem of how do I get to my suppliers, how do I understand those suppliers. We're having some noise on the phone line, so
if you'd like to tell me where
you're in there talking. Okay, let's try that again. So the bottom line is people are moving forward quite aggressively, trying and focus on extended information visibility part of their supply chain. So they're making investments along the way. They're exploring the legal limits and challenges of where they stand, and they're in a position to try and understand what they can do to get better systemic capital supply chain information. So if we move on to identifying the risk, we showed a little bit earlier about how people went about identifying some of the risks associated with the supply chain. But the other thing to understand is which ones matter. Because when you're sitting there as a supply chain executive, when I ran a business that was in fact in the supply chain world, what you found is that I was inundated with risk. And the last thing I needed was somebody giving me 5 more risks that I needed to worry about. What I really needed was the ability to understand which risks matter versus which risks distract. And so an important part of looking at the risk associated with the business is to understand not only what risks you have, but which of those risks matter, which ones you can manage, and which you simply have to react to. So if we move to the next slide, we talked a little bit about supply network architecture. Very importantly, if you go look at the vast majority, like over 90% of procurement decisions are made by two people without the strategic visibility in the company. One is engineers and product developers who are making decisions about who they're going to involve at the design process level that then neither the supply chain nor procurement can do anything about. The other half of the problem comes with the procurement professionals who are doing their dead level best and doing as good a job as they know how to do with the tools that they have to make good decisions about which suppliers they want to use. But in looking at those suppliers, they're taking a tactical transactional view, not trying to think about who are the people that have capabilities we need, who are the people that have a different risk profile than others, and how do we think about strategically, how do we design this supply network that extends beyond our organization. Now, some suppliers simply, you've got 4 or 5 choices. It's commodity material. It won't affect your production process to switch one to another. Not a big challenge. Maybe that is tactical, and we should use the traditional strategic sourcing tools. But for those people that are single source, sole source, or engineered suppliers, meaning that they're integrated into our production process, those suppliers have to be thought of and treated very differently. And we have to think about segmenting the supply base and managing those suppliers very differently. Supply network architecture is, in fact, the framework successful companies are using to say, how do I understand how I need to manage my supply network differently, and how do I then go about that so it becomes a strategic, thoughtful decision, balancing cost, performance, and risk, and not simply a tactical decision, how do I save $1 here and there.
I was on a board, and we were selling something, which I would like to be on a board of a company that sells something. How would I know my supply chain architecture? Was that a responsibility at a board level to know that?
It's a responsibility at the board level to know that you have it, to know this. Board member and part of the important role we play in the business to make sure that the company is in fact addressing the right sets of issues. What they should be demanding of the company is there is an overall systemic process that ensures you're looking appropriately at the supply base, at the suppliers, and that the right decisions are being made by the right people at the right level. You've done in a lot of cases, we do not want engineers or purchasing people making these decisions. They ought to be part of the process. They ought to give input to the process. But these are fundamental strategic decisions about how we're going to be growing the company, and you ought to think about it the way we think about capital investments in the business, because the alternative to making a capital investment yourself is selecting a supplier, a group of suppliers to do it for you.
So when I look at the slide that you have up with the supply network architecture, I see 6 horizontal bars across the chart. Now, those are the dimensions when we think about an architecture that we should think about. And then the sub-elements, the tabs, if you will, on the bars, then are those the data points that we're looking at? Is that how you would describe those areas?
Those are the issues and challenges you need to be thinking about in each of those areas. So if you're looking at supply disruption, these are the factors that you need to think about very carefully in thinking about each one of those suppliers. This is the framework you should be applying to the supply base to say, how is it we should make decisions and how is it should we move forward? This is simply a checklist and a framework to allow people to say, these are things we ought to have specific policies, we ought to have specific strategies, we ought to have specific understandings so that people can execute within a coordinated framework, not make the best transactional decision that they have.
So instead of trying to save a penny on a piece of supply, it's more the interfacing of these items. And risk then, when you talk about inherited risk, then could come through any one of the dimensions or any one of these data points or concerns that you've identified.
I think that's absolutely right. And for most companies, when they start working in the supply base, what they're chasing with a lot of their suppliers is they are chasing pennies with dollars. They're not making smart trade-off decisions. They're not investing where they need to invest. They're investing where it may be most visible to invest. So a network, just like an IT architecture, causes you to focus on the right sets of issues, the right set of challenges in a priority way and in the right manner. The supply network architecture does the same thing.
So for those of us that are watching the webinar today, we need to be able to answer these questions about our company across all the products and services that we offer.
Correct.
All right, let's move on and talk
at least I should say, we ought to address those suppliers that are not a fundamental commodity for which I have multiple sources in multiple parts of the world. Again, this could be an overwhelming task if you got 7,000 suppliers, if you have to focus on every one of them. It would be nice, but what the emphasis and priority needs to be on those that make a fundamental difference in our capabilities, those that are engineered into our product, those that are sole source or single source. And that doesn't mean you shouldn't have sole source, single source, or engineered suppliers. It simply means you should be managing them thoughtfully and carefully, not by an engineer making a decision or a procurement manager making a decision about the best transaction at a point in time. It needs to be thoughtful about how the company ought to evolve long term, as we're thoughtful about how our plants and our distribution facilities and our internal capabilities need to think about the capabilities of our supply network, and this is a tool to help you do that.
All right, so when we move ahead to the next slide, Bill, with top performer findings. Wally, what can you tell us about this?
The major issues that you see here are people thinking fundamentally differently about the supply chain. You know, what is the optimization framework I should be using? What risks are involved? How can those risks be managed and mitigated? We need to be in a position to think very carefully on a number of questions. The key thing you're trying to address is how can the new supply chain be optimized while you can't operate a supply chain with no risk. You can't operate a business with no risk. In fact, you could make a strong case that the purpose of a business is, in fact, manage a specific set of risks. At least that's one way to look at it. So I think, and very importantly, is you need a risk framework to make sure you're focused on what are the right risks, how do I manage those risks, how do I optimize my exposure to those risks, and how do I then minimize the impact or damage they can do to my reputation and to my customers' operations. So if we go to the next slide, again, today's supply chain is very different. Let me summarize some thoughts here. One is it's global. It's large by others. It's limited information visibility. All of this, as one of my supply chain executive clients put it, I feel like I'm trying to land a 747 with concrete windows. I don't have the overarching frameworks that I need to allow me to make appropriate, optimized people from every direction. But when you look back, to reduce their risk associated with the business by appropriately applying some risk frameworks and tools to their supply chain. I'm not trying to say the supply chain is all about risk management. I'm saying that risk management has not been thoughtfully enough applied within the supply chain to help and focus the trade-offs companies have to make. And then finally, most importantly, one of the biggest issues that's emerging is that companies are inheriting the risk of their suppliers. What you don't know can hurt you. And it's a risk that a supplier may not think twice about, you should think very carefully about, because you're the ones that will pay the price for it. You're the ones that will get blamed for it. So if we move to the next slide, which talks about top performers manage their supply chain with a very different approach. The supply chain scope includes customers, suppliers, and their customers. The priority focus on visibility. They're doing this through surveys and doing this through analysis frameworks, but they need to be able to understand supplier risk and supplier capabilities, where they have threats and where they have opportunities across the supply base. The supply network architecture is an approach many are starting to use to sourcing. It provides a strategic, not a tactical, framework for how to move forward in making supply-based decisions. The top performers clearly understand risk that matters versus risk that distracts, and they're also very active in designing in risk that can be managed. So if we move to the last one, top performing suppliers also must manage much differently in this new world. We've talked about this a lot from the standpoint of people who own a supply chain, people who are the, if you will, the drivers of the supply chain network. What does this mean for suppliers, people who may be a supplier within a larger overall network? It means that I have an opportunity here to market solutions to customer perceptions of risk. In fact, we've worked with several companies that are in fact using their ability to manage risk differently within their operations to in fact gain market share with their customers by the fact that they're able to much more effectively manage risk for their customers than the customer can manage for themselves in many cases. So this ability to understand their risk and be able to effectively manage those risks represents a real sales opportunity with a number of customers. Rigorously protect and manage intellectual capital. The number one leakage point for intellectual capital of a company is in fact through its suppliers. There's lots of people who would be very appalled at giving up their own intellectual capital and trade secrets, but are not very good at managing their customers' intellectual capital and trade secrets. This is an area that needs a lot of attention and a lot of focus, and one that people need to think very rigorously about protecting and managing both their intellectual capital, those of their suppliers, as well as those of their customers. Need to provide visibility into schedule, capacity, inventory, and capabilities. This is part of managing the risk. In some cases, it's going to be an embarrassment because there may be something that the customer will see very quickly that if you're having a problem. But you want the kind of relationship with your customer if you're going to sell, gain market share, and be a large supplier to a customer. You want that customer to understand the realities of what is going on in the supply chain in your business, and then you have to be prepared to manage it. I'm not trying to say you should give people unfettered access, and there are legal limitations, but it represents a very powerful way for you to interface with a customer and change the customer's performance, or I should say purchasing thinking about how they should view you and how they should transact with you in a very different way than let's just talk about cost. That leads to the next point, which is emphasize value over cost. That doesn't mean that cost pressures are going to go away in the supply chain. They're not. But when I can meet a reasonable cost but provide a significantly different value, and in this case, risk is increasingly becoming a part of that value. If I can provide a capability that the customer values, even if it's not at the lowest cost per piece, I'm in a position to gain market share. And now you move yourself from a price-based competition to a value-based competition, of which price is one factor. And finally, they view themselves, the successful suppliers view themselves as an extension of their customer supply chain and the value proposition of their customers. They're constantly looking for ways to work with their major customers and be in a position to say, where can I add additional value? How could I do something differently with my product or the way that I'm supporting or servicing that product, which would add value to my changes the relationship dramatically. Let me end with kind of an example. I worked with a community products company who was supplying packaging materials, and was in a very cutthroat marketplace with very high pricing pressures and, in fact, lower profitability than they should have had because of the intense competition within the industry. And they have been fighting the battle with new products. They've been fighting it with reducing costs. They've been fighting it with a number of different challenges. And one of the things we evolved with them was the ability for them to step forward, and they actually took on the responsibility for some of their large customers, people where they had high market share. They actually stepped in and said, I will take on the responsibility for retrieving the product from your production lines, packaging it up efficiently, and then delivering it to your customers. They moved from being a supplier of packaging materials to being a packaging solution provider. They tripled the size of that business in the first year and doubled it the following year. It became the most profitable part of their division, and it was by looking very carefully at where they could add additional value with a differentiated cost structure in their customers. And they, in fact, moved the number of customers from a low share position to a very high share position. And the profitability of that increased, as well as the profitability for their customers. So top suppliers are looking very carefully at the customer's extended supply chain and how they may be able to add value and get reimbursed for that value, whether it's in share, profitability, or in most cases both.
Before we go on, there's some interesting things on this slide, and I'd like to ask you some questions about it.
Sure.
As we focus on this. So when we think about looking at market solutions to customer perceptions of risk, how does a company go about doing that? What should I be thinking about? If I'm supposed to market my solution to the customer's perception of the risk. If the customer's perception of risk is the risk is low, we know in fact the risk is high. Give me some insights around that.
Well, there's some customers you're not going to be able to market this to.
Okay.
So this is not a universal formula. There are some customers that are going to be viewing you as a transaction, and maybe in some cases of your product areas, that's not inappropriate. But if, on the other hand, if you're in a position where you're engineered into the production process, you're a sole source supplier or single source supplier, as I've had a number of clients, then I think you're in a position to be able to say, let me understand the perspective of my customer as to why they buy from me, why they buy from others. Let me understand how they view that transaction and that relationship. And then let me understand the risk associated with it. And then I want to publicize to them how I'm managing risk they should be thoughtful about. And in many cases, you wind up with an education process. Again, it's not going to take place I had one of my clients who was making the product in a single plant. And the customer was very content with that, didn't see a problem with it. They looked around and said, well, we have 7 plants. We have, somewhat the same equipment in at least 3 or 4 of the plants. And they went through and qualified the product to be able to be made in 2 other plants. They then went through back to the customer and said, look, we realize we're a sole source supplier to you, or at least, sorry, a single source supplier to you. And we're making it all in this particular facility. And we intend to continue to do that because that's cost effective. But what we have done is go through and qualify the ability to make this product in 2 other of our plants. So we don't want you to be worried about the fact that we can support you. To which they went, gosh, we never thought of that. And what was interesting is they went back to 2 of their competitors who did not have that capability. And as a result of that dialogue over a period of time of about a year, they dramatically increased their market share. So the customer may not be aware of the risk, but if you go through and educate it as part of an overarching sale process and the ability that you have to come in and be in a position to help solve a customer problem, whether they realize it or not, I can then grow the understanding associated with that, and I'm in a position that, in fact, I can gain from the customer.
You pointed out a bunch of things in that answer, so it was good. You actually kept me awake through that, and it worked out quite well.
The first goal of a presenter.
The first goal of a presenter is always to keep the audience awake. I think when we look at this, you're transforming the risk into a value proposition. If you're educating your customer up front, as opposed to letting your competition educate, as an example where you worked with a client and they took that, dealt with the weakness, created it as a strength, you're transforming crisis into value or risk into value here and having the client select you because of your supply chain capabilities. So I think that's an important lesson that sometimes when we focus on supply chain and we're focusing on suppliers and reduction of risk or trying to control and identify it, maybe we ought to play the game with all the cards face up, bringing that issue in, and it would lock those clients into us.
I think that's a great point, Jim. One of the things that I think has emerged from the last 5 years at least, maybe 7, I think it's going to become a huge opportunity over the next 5 to 10 years, is that supply chain is going to become an integral part of the sales marketing process of a company. And that represents a huge opportunity. In the past, frankly, supply chain has been kind of where we make this stuff. And the people in the supply chain were largely viewed as tactical people who did and executed tasks, and the goal was to not screw it up. And so the best you could think of as a supply chain executive when I first was working in space was, don't screw up. There wasn't really an opportunity for supply chain to make a difference in the marketplace, other than negatively. I think now we're seeing is with the growth in risk across the supply chain, with the lack of good tools and frameworks of most customers to really understand and deal with those risks within the 4 walls of their company, what becomes very important is the ability of us to be able to say, how can I provide value in a way that the marketplace is going to value? And a lot of these ideas are coming from the supply chain. They're coming out of supply chain executives and the talented people within the supply chain thinking more broadly than just their operations are simply a better way to solve that particular problem. And for those companies that do it, they are creating dramatic advantages that are extraordinarily difficult for their competitors to match. Because the first mover in this space gets all the market share and gets all the profitability gain. Everybody that then follows that in order to stay in the business, those people are in a position where all they get is the cost.
Well, it's exciting to see supply chain moving out of having to worry about what color is the pocket protector to keep my pins in my pocket to having now a strategic aspect within it. And I think your architecture analogy.
7 of my recent clients, their supply chain people are part of sales closed presentations. They're actually taking out supply chain executives to talk about how the supply chain can better integrate with the customer supply chain and creating a whole other level of dialogue that is very powerful inside of the business when all of a sudden, I think increasingly supply chain executives are becoming more strategic players inside the company. And the supply chain, people with supply chain experience and capability are being thought of for much higher positions inside the company. I find that to be very exciting.
The next point you've got here on intellectual capital, I remember you telling me a story about a company coming to the realization that their intellectual capital is actually owned by their supply chain instead of being owned by them. Do you want to clarify that just a little bit more on that subject?
I mean, the reality behind it for most companies is over 85% of the capabilities of the company are embedded in their suppliers. In reality, the supply chain owns you. You don't own them. And an understanding of where and how we want that intellectual capital to be dispersed across the supply chain. When that intellectual capital matters to our customers, that becomes very important. If you look at it, the way people ought to be thinking about intellectual capital is what are the things that are so critical to my product, so leverageable in terms of my size and scale that I can own it, that I can maintain it over time. Those are things you ought to look very carefully and be very suspicious of any potential to outsource that, even if it looks financially attractive on a transactional basis with at a particular point in time in the market. There's great value in the production of materials and capabilities that are strategic to the next generation of product being inside your company as opposed to being inside a supplier. However, if you don't have the scale, you don't have the ability to support it and protect it, you don't have the ability to outgrow it, then having that own intellectual capital inside of your company, in fact, is a higher risk. And let me give you an example. Some of you may remember a company called Cincinnati Millicron. Cincinnati Millicron was at one time in the U.S. back in the 70s. They had almost 80% market share of machine tool purchases. They looked at it and said that the control systems of the equipment is a critical intellectual capital we have. It's critical to our business. We're going to maintain that. So in the face of Silicon Valley and Route 128 in Boston and all the companies in Japan in technology, all these 3 areas which were moving forward with chips and computers and controls technology, etc., they tried to build it in Lebanon, Ohio, where there was no infrastructure around it. Everything they needed, they had to get in from these other places that were the centers of this hotbed of intellectual capital development and control systems. And within 5 years, their control systems were second to the major import competitors and even some U.S. competitors. The net result of that decision to try to own that intellectual capital when they didn't have the resources to compete around that intellectual capital was they drove themselves to a 25% share of the machine tool marketplace within 10 years. So it's important to maintain intellectual capital. It makes a difference, but only if you can afford to support it and maintain it. It's critical to the product. It's critical to your success of the company. Otherwise, you need to think about having other people own it. Now, how do I link in partnerships with those people so that I get priority access to the intellectual capital and I get preferred position for the new developments coming out of that intellectual capital? You know, that's what the Japanese machine tool makers did with the controls industry in Japan. And today, Japanese machine tools have over 80% of the world market share of machine tools. A very interesting case. You've got to think about intellectual capital as a threat as well as it's an asset. And thinking about which one you can do and how you do it, again, that's why it's not a tactical decision of do I invest in a new piece of equipment or a new engineer. It's a strategic decision about where do I want the intellectual capital of my firm and how do I manage that.
Lots of complex issues around that. Firestorm has found that the largest single failure in a disaster or crisis is supply chain. And I think in our discussions with the University of Alabama, as we were talking about supply chain and what this means, I think it's starting to come together. I want to comment on one more before we move to try to wrap up today. The aspect that you've got up here, provide visibility. You had a slide early on where you were talking about that manufacturers were spending $1 trillion, which I think is close to what your bonus was last year, if I'm not mistaken. Looking at
I haven't been able to cash that check.
Looking at that 15%, 10 to 15% that was in-house, and I believe what I understood you to say was that they're not really looking at that risk that's outside of that. They're not investigating it. And so visibility into the supply chain and into your supplier's supplier, and because, again, if you've got thousands of suppliers, your supplier has thousands of suppliers, they have thousands of suppliers. Obviously, it gets very complex very quickly with how many different numbers can come up when I push the machine. You can tell where my level of interest is. It's always in winning the lottery.
The lottery must be quite large today.
Yeah, it would have to be at this point. But so what I think you're saying here is that if you don't have that visibility, you are in fact playing the lottery. You may win, you may lose, but more likely you're going to lose because there's always more losers in that lottery application. Is that really where the point is?
Slightly different. Matter from the risk that distract. So I may have thousands of suppliers that have thousands of suppliers that have thousands of suppliers, but only a limited number, a segment, if you will. That's why we talk so much about supplier segmentation. But only a segment of the suppliers, and those suppliers are in fact in a critical role within the business where I don't have good and rapid and cost-effective options. So that's about anywhere from 3 to 20% of the supply base, depending on what company you're in. So the numbers get a little more manageable.
That's good.
So think about it as just as we have tailored logistics streams going out to the customers, we have tailored supply the streams that are done based on segmentation out to the supply base and their suppliers to be able to get to those sets of issues. The visibility issue is there was $1 trillion invested over the last 25 years. The question is where the investment's going now. Right now, that investment has all gone into what's inside the four walls. Maybe some 5% was going outside of that. But what we have to be thinking about is what are the appropriate tools? What can we do legally? How do we work with those tailored streams of suppliers that matter to give us the information visibility to understand what's going wrong and how we react?
All right, as we wrap up, Phil, and if you bring us back up to the next fighting today's battles with yesterday's thinking, I think you shared with us, Wally, that the world has changed, and it's changing at an accelerating rate. And when we turn on the television every day or the Internet or look at a newspaper, they actually still make those newspapers. There's significant impacts all across the supply chain that are impacting us in these areas. So as we look forward to the series of future webinars around supply chain and other risks, we want to thank the University of Alabama for underwriting, the University of Alabama Continuing Education Group for underwriting this webinar today and sharing these thoughts. And there'll be some opportunities for workshops and other events to attend. And in fact, if you get a chance, you can come by the 2013 Business Expo in Mobile, Alabama if you're there. But I guess if you're listening to us today in Seattle, Washington, or outside the United States, it'll be a little hard to get down there. But there'll be a chance to meet one-on-one with some people from the University of Alabama and from Firestorm to see if we can give you some help in those answers. We're going to try to reach out to everybody that's on our call today. We had a few technical glitches as we got into our call today. We'll try to answer your questions individually and look forward to having you on a webinar again soon. Thanks, everyone. Have a great day, and we hope to speak with you again soon.
Thank you.
Goodbye.